This particular class is called Active Retirement Investing, and it's to give you the empowerment to do your own investing if you wish. The book that you have lays things out in a step-by-step process. The process that we follow is in thirds. The first third we talked about is the personal financial planning review. So you want to make sure your cash flow and everything is in good shape. Everybody knows that. But now I need to go back and make sure those things I've bought or ordered, cancel them if you don't get them, because the computers can keep billing you for things, right? That's the little stuff. Then the insurances, right now, where I see people that don't have proper insurance, like on your car, you want to have maximum liability, but remember that uninsured, underinsured, if you get hurt and it's not your fault, an extra $300,000 to $500,000 would help carry you. Younger people need that more, because if they're disabled, they have a longer time to be disabled. They don't have the money that maybe, or the pension that maybe you've accumulated at this point, right? So tell the younger people, and that's the other thing about this class, pass it on. Pass it on, and then tell everybody else that you know. Little tidbits that nobody wants to hear about: uninsured, underinsured motorist on your car, get that up to $300,000 to $500,000 to protect the person. The other insurances are, if you travel, make sure you have travel insurance that has medical evacuation and coverage. I had a client go to Germany, broke her hip, she had to pay cash for the surgery. Fortunately, it was only $5,000 and she's wealthy, so that's fine. But other people, I've had other stories that are crazy. So have your younger people do that, or if you do it. As we get older, we worry about an illness, injury. Younger people get injured, backpacking and things like that. The other insurance is long-term care. If you don't have it and you're not paying for it, you have to start self-insuring and building up the assets and layers that if something happened to you, you could do that. If you want to buy it and you want to spend a lot of money, that's fine. We have a client that pays, we have to send her $16,000 a month to pay for her long-term care. And she lives at home. She has live-in people. So research that, say, I don't need it, that's fine, especially if it's an individual, if you don't have a spouse. If you don't have the coverage, it's probably too expensive to buy, so just start investing appropriately to where you could have income and assets. I would stay away from the annuity products for those types of things. If you have one, it's okay to still have it, but the annuity policies are out there that sell long-term care. Be careful. The other insurances, umbrella policy, liability, right, in your car and your house and all that kind of stuff. If you have retirement plans only, like a 401k or a rollover IRA, and your house is worth $650,000 or less, then the umbrella policy is not quite as critical. The umbrella policy is there to protect your equity over $650,000 on the house, and for non-retirement investments that if you got sued, they could take them. Your rollover IRAs, your 401k, your deferred comp, that's all protected. Your little individual IRA on the side, not so much, but California's pretty good about that. So we're just saying, if you park your car on a hill and the brake comes off and hits a bunch of people, you got to be prepared for worst case scenario. If you have a big pension and a big 401k and your house is not worth a lot more than $650,000, there's not a big need for that. But make sure we have all the medical and the long-term care, if you have it, or the assets to cover that, and the umbrella on everything. This is California. Then into the estate planning, we all need to have a will. We all know that. But if you have a spouse or a partner or a relative that's a beneficiary, then everything goes to that person. The will is not as critical, especially if they're a close family member. They would go through the garage in the house and get everything, that's fine. But a will is nice to lay things out properly. The document you must have, and you must promise to get before you leave here, is a durable power of attorney. The word durable, to me, just means that it kicks in only if something happened to you where you're not quite dead yet, right? And the durable power of attorney we are all familiar with is the medical durable power of attorney. Pull the plug or don't. I have horror stories about that. You want to make that very clear. If you have that document, then tell the person that's in charge what you want if something does happen. But the one that we tend to forget about is the financial legal durable power of attorney. That's the one that if I'm incapacitated and I might recover, I need that person to step in quickly and handle stuff. If I'm settling a real estate deal to sell or buy or refi, if something happened to me, if I'm married or I have a partner or a relative, they can't do anything without a legal authorization, and they can get it through the court, but how long could that take, right? So if you want to be able to handle things quickly. So the big deal is uninsured, underinsured motorists, raise it up to the top. Then the durable power of attorney, get those done. You can do them online if you want to. Living trust is nice. If you, an individual person that has assets that you want to make sure that they go to somebody else that doesn't have a beneficiary provision, you absolutely need a trust. But if everything has a transfer upon death of a beneficiary, it's not a big deal. But maybe those people, you don't want them to get the money outright. Maybe you want somebody else to keep control of it, so a trust is important if you've got the time. If there's a partnership, husband and wife or partners, a trust is nice because then if one of them died and the other one's not into this, you've already organized it, right? But it's not absolutely necessary if everything goes to another spouse. And as a matter of fact, I tell people it's a perfect example. If you don't do a living trust and you've got a partnership or a couple together and one says, let's go out to dinner, honey, and you go, no, I can't. We don't have a trust. What if we both die at the same time? I'm sorry, honey, I can't go with you. Right?
Like the royal family, we just take separate jets.
Yeah, exactly. Right. Or my son, he teaches a lot of classes and he's 26 and he's getting involved in the business. We went to a conference, we have to fly into separate jets. We don't go on the same one. Our clients and our staff and everybody else would have issues and things. So, and I don't expect that to happen, but you just have to do the right thing. So the legal documents, the durable power of attorney, big time, the will and the trust, you could get away with them if you can put transfer upon death on the house and other people. Between legal partners, husband and wife or wife and wife, if you own a house together, as you guys know, joint tenancy is fine to make sure the survivor gets it, but if it goes up a lot in value and one person dies, they leave their half to their partner tax-free up to that point. But the partner still has to pay taxes on all this gain with some exceptions of cost and exclusions and things. So it's nice to at least own the house and community property or own anything else in community property if you're in a legal partnership, because then if one person dies, the other gets their half tax-free as well as the decedent. So I have a couple came in yesterday. I had been working with a father for like 30 years. Father was 97, just passed, so the son, I've known him for a while. So we're going to take, let's see, Dad's living trust, put the son on as the trustee because he was the co-trustee. Then he'll immediately pay out what he needs to the beneficiaries. Then his amount will change that account to community property for him and his wife, because he's not going to get to getting a trust done soon enough. A trust will deem the assets community property. It'll have it in the writing. So we'll do community property, just buy us some time. But on real estate, it's a good idea if you have a legal partner to have it community property so you avoid any capital gains.
Do you think there's a big difference between joint tenancy and joint tenancy with right to survivorship? Is that
they should be the same.
The same?
Yeah, but there's one exception. A joint tenancy with right of survivorship, what is it called? There's a legal name, per stirps. Hi, come on in.
Sorry, I'm late.
Yeah, that's okay. So there's something called per stirps, so joint tenancy with right of survivorship. So if one dies, the other gets it, right? But if there was an accident and one died and then the other one survived, they're going to get everything. And then they die. Then there's a per stirps, meaning their beneficiaries then get that. Kind of nice. So you get the little details and all that kind of stuff. And obviously, if it's complicated, then at some point you hire an attorney, right? But if you've got a simple estate where you've got a big government pension, your house isn't, regardless of the value, you can put somebody on as a transfer upon death. They're mature enough to get it, then there's no worries. But you want to look at everything and see whether or not you have a complicated issue. A living trust is great. It's good to have an attorney, but you're going to spend $3,000 and they're going to put it in a boilerplate and bring it out, and unless you've got a complicated situation, you might be able to do a living trust by yourself. However, that said, if you have a complicated situation, I wouldn't mess with anything that goes beyond stuff like that. So two different versions. And if after you're done looking through the book that has these steps of financial planning, it'll give you an idea. You might go, wow, I need to go see an attorney. And you can go to YouTube and watch attorneys talk and learn about this stuff and see whether or not your situation merits paying $3,000 for a trust or not. If you're an individual person, most likely, because if you have kids or grandkids or everybody and you want, this person gets the money, this one keeps it in savings, the living trust lets you do a manuscript, kind of like a Hollywood movie. I have living trust, I paid a lot of money for it, but I have an LLC in California, and you guys should learn about this other, what is it called? I'll tell you about it later, but people can invest, they can put a bunch of real estate in an LLC and have their private retirement trust in California own those assets and have liability protection.
Yeah, we have a lot of questions about that,
Okay,
actually.
okay, good. Yeah, there's a special California trust that's similar to a 401k back in the 70s that they created for contractors or big investor, big people that own companies and things like that. You can create your private retirement trust, PRT, in California. I don't get a tax deduction, and I don't have to add anything for anybody else, but I put all my properties in it, the private retirement trust, and it's talked about a little bit in the book. And then in there, if I had an accident and somebody sued me, I get to claim my properties as my retirement program, therefore having liability lawsuit protection. You can't take my properties. And then I have a bunch of them in one LLC, which would normally you'd have all separate LLCs, but because it's owned by the private retirement trust, no problem. Anyway, that's going off into the weeds. So cash flow, look at the insurances you need and you don't need, the estate planning documents. Most of us don't need to pay a lot of money. You might be able to go on LegalZoom or something. But if you feel you have the need, start watching some videos and see whether or not they're talking about, yeah, I think I need to hire an attorney. Then they're worth their salt. But if you don't need them, they'll be happy to charge you the $3,000 to $5,000. So I'd be careful. And if you have a trust and you want to make some changes to it, they can do a restatement. You don't have to do a brand new one with a new name. The only problem is the restatement charge almost as much as what a new trust is. So the attorneys are like dentists. They somehow organize their prices where they're all the same. And you can't get out of them. Now, if you don't want to do it yourself, you could have a paralegal look at it, but still watch some videos and determine whether or not you want to do that. I crossed the line to where I have to have an attorney and I have all these documents, so I'm just willing to do that. But I hate to see people waste a lot of money because you may have the attorney just bring a program, put your names in like LegalZoom would do, print it out and say, there you go. And LegalZoom will do that for you if you have a simple circumstances. However, you could start filling in all the blanks and realize this is too much. I'm going to go see an attorney. But still, you'll have to bring in all that information. So if you have a simple estate, at least consider doing it possibly by yourself at that point. So let's see. That's the estate planning. The taxes, obviously. We've either all had your taxes done or you're almost ready to do that. All you can do is go watch some videos again. YouTube is great. If you get past the salesperson, right? Into taxes, you could have some CPAs and accountants and people, or you could look how to reduce my taxes in California. There's usually financial planners that are trying to get clients, or CPAs or somebody that will give you some really good advice that's out there. Then you can kind of settle everything down. The basic ways that people do that, and one interesting thing in real estate, remember that SALT tax? Where you lost, what was it, the maximum amount of state income tax was deductible, and I think within that property taxes were, right, limited?
Yes.
If they don't do anything, that will expire and go back to where it was, meaning you could write off all your state tax and your property tax. Because when SALT tax came out, these big rich homeowners, they could write off their property taxes, right? And also your state taxes. And so I'll buy a mansion, the property tax, I don't care. Or I'll sell my house. The problem I would have, and anybody here, I'll sell my house and pass the cost of selling it. I might not have a capital gains because you can have a $250,000 exclusion. A couple is $500,000 plus costs and all that stuff. So I might sell it because I'm tired of this place. I'm going to go buy down there, and I can move my property taxes over there and keep them fairly low. But if I move out of the state or I buy something bigger, the property taxes could go up. And in the past, it was a deduction. Who cares? Let's buy a big mansion on the water down in Malibu. But now they capped that down to $10,000, so they can't write off those $50,000 a year property taxes, and that has an effect on the real estate market, right? That's frustrating. That's going to expire in a couple of years. Now, knowing Congress, they'll extend that part of it, but because that's money they don't want to give up. But theoretically, if nothing happens, that will improve in a couple of years. However, your income tax will go back up. So, but it's fun to watch those videos and keep up on what's going on. So that's the tax, and obviously if you're working now and you can afford to do a Roth IRA, that's fine because you put it in after tax and it grows tax-free. But if you're working or if your income's moderate to high, we need something that's tax deductible in hopes that you have more time, you can buy time to decide what to do later to bring your taxes down when you fully retire. Maybe you start a solar farm or something, but it's just intuitive to get the write-off right now. A lot of people say convert your IRA to a Roth IRA, but you've got to pay the tax on the way there. If you have a year in which you run a business and you take a year off and you're going to travel and not have any earnings, you could take some money out of your IRA and convert it to a Roth. You're in a lower tax bracket, and then the Roth will grow tax-free. But I love these people that get online and say how to live a tax-free retirement. You know, what this guy's saying is, take out your $500,000 IRA, convert it to a Roth, boom, you just lost 200 grand. Now you got a $300,000 Roth IRA, and you'll live off that tax-free, but it's a lot smaller, and you'll use some of that earnings to buy an annuity through this guy that might give you some growth, and then also he'll have you buy life insurance, so when you die, you're dead, the life insurance covered the money you paid in taxes to the government to do the Roth, so your kids get all the money tax-free, but you don't. So there's always strings attached. There's no real easy way to save on taxes. Years ago, you could buy a limited partnership, which I wouldn't do. A lot of them fail, but you got passed on tax deductions. Real estate, years ago, we could write off everything against our ordinary income. Now they limit that. So it's almost pays more to pay cash because the write-offs are less and the cash flow's there to be offset. But if you don't have any cash flow and you've got all these other write-offs, they don't really help you much. It maybe help you someday when you sell the property, but I don't plan to ever sell my properties because I'd be killed with the cost and taxes and or whatnot. Even on my house, it would cost me $100,000 after all the cost to sell it and the taxes. It's ridiculous. So I'm just going to hold on forever. And
why that would happen? Why it would be so expensive because of selling?
I paid $150,000 for the house. It's worth $850 now, so I could sell it and not pay taxes on $150, and then I had $250 exclusion, so that's $300,000, $400,000, $500,000 not taxable. But if I sold it, everything over $500,000 would be taxable. So another $300,000, $350,000 would be taxable, and if I had $300,000 gain, I'd lose $100,000 to taxes. That's the problem, right?
Can you offset your capital gains a little bit with any improvements on the property?
Yeah, keep a good record,
Yeah.
and you can add those to the cost. So if it cost me $150,000, but I spent $50,000
Yeah.
that I didn't get to deduct, I'd add that in there.
Okay.
And almost everybody says, I don't know where the receipts are.
Yeah, that's an important thing to keep track of.
Yeah, and so the government says, okay, well, I did a roof for $10,000, we'll all try to fudge it a little bit. We know we spent the money on it, we just didn't keep a good file. But that's a good thing to do at that point. And so that's why we want people buying and selling real estate, because it triggers a little capital gains or a little higher property taxes. I think you guys would appreciate this. And soon, Shanique will go public on this, right? With SOS?
Yes.
Okay. So I wrote an article on Save Our Social Security. And it relates to this kind of stuff. If we could go and change Social Security around a little bit to where currently, if you're a business person, you pay Social Security tax on the first $168,000 of income. If you're the owner, you'll pay about 12-point-something%, or employees pay 6% and the owner pays 6%. So you only pay it up to $160,000. Our plan says you're going to pay Social Security on every bit of earned income in your business. And the wealthy people panic, oh no, that's terrible, that's unfair. Well, in our plan, it's based on 3 different levels. We have a lower level of lower income people that get Social Security, but they also get a security card they can use to buy things at the grocery store, Walmart, and whatnot. And that's a big network like the military does, where they get like a 20% discount. So if you're a lower income person getting $1,000 a month, you're going to get $1,200 to $1,300 in buying power by using your secure facial identification and everything on your app or your thing. And the government works hard to get the cost down. And so you get a discount if you have this card, because like you're a member of Social Security. The second level of payers, individual taxpayers, are encouraged to add money to Social Security. So you give another $10,000 or another $50,000, or I inherited, $100,000. You put it and give it to Social Security, and now your benefits go up. But there's a catch. Those benefits are for you or your spouse. If you or your spouse die, all that money you put in disappears, goes back to everybody else, right? And then the wealthier person that paid on $1 million of income instead of $168,000 complained all the way in paying them, but when they reach a certain age, like 75, and I made it really older because not everybody lives that long. Our goal is you'll die and we'll keep your money. But if you make it to 75, right?
Depressing.
Yeah, but if you make it to 75, you get all the money you paid into it in tax credits, okay? So whatever other income you have, you can offset tax liability with tax credits. Or if you have a big real estate property or properties or business, and you paid in $2 million in taxes, you can get all that back in tax credits. And then you can sell that apartment building, that house, pull money out of the pension, and it's dollar for dollar. And you'll get it back. You could even have it grow a little bit. So it's like, oh, okay, this is a part of my financial plan. I'm going to overpay in my Social Security tax, but I'm going to get it all back when I go to retire because I need to sell things. See, the problem today is, especially in real estate or appreciated assets, if you took all the time to buy those and all the sweat and tears and stress and all that stuff, and now I'm ready to sell it, I can't, because I'll pay $100,000 on my house. I have a property in Grass Valley I would pay quite a bit on, and it would just be no fun. I've worked all these years, sacrificed. I go to sell it, I get wiped out with capital gains, state, federal, Obamacare tax. That's what, 3 something? So it would just be all these taxes. But in this plan, I would then go to my tax credits from Social Security, because I think I paid in over $400,000 and all that stuff. I would have 400 and some thousand that I could offset pulling money out of my pension plan a little bit at a time, or sell a piece of property. And the beauty of that is the wealthy person gets their money back, the middle class person gets a lot more income, and if they live a long time, they get a much better retirement, and they can invest it and know that it's relatively safe with the government. And then the lower income person has everything controlled for them. They don't get cash, they get a card, so nobody can steal the cash. They use the card at the grocery store or wherever they are, and so nobody can take it and use it. All that would be secured. So that helps. Now the biggest benefit is, if we can get these older people, like myself, that are saying, to hell with this, I'm going to sell these properties. I've had my time with them, and if I could offset the taxes, what happens when you sell a property? Well, I'm going to pay a real estate agent. I'm going to pay title offices until blockchain comes around, and then I'm going to pay to have it fixed up. I'm going to pay whatever, put a new roof on it. I'm going to do all these things, and all those businesses generate income from that. And then when I get the money, I am going to pay some taxes, and I use my credits to offset it. But there's a long list of people and businesses that all benefit when I sell this building. What about the person who bought it and sold their building? There's a whole line of things there. We need to turn things over. If you don't, the economy will die. The worst thing you could do is have no one buy and sell real estate or businesses or stock. That would be a problem. In the book, I talk about the S&P 500 index fund is great, but if everybody bought it and never bought and sold, the thing would tank because you'd have no reference of what it's worth. That's a problem. So anyway, that's the Social Security thing. The rich people pay more, but if they live long enough, they'll get money back. And then that also helps the lifestyle. Hey, you want your money back, you need to live a clean lifestyle. Clean up your act, or you're going to die before 75, and you're not going to get your credits back. If you use them earlier than that, maybe they're discounted. But we use capitalism and socialism together, and it helps, in my opinion, everybody. So I'm either going to get a lot of hate mail or not. But our legal department isn't done letting me do it yet, but we'll get there. So when you go through the cash flow, the insurance, the estate planning, and the taxes, the last thing that we talked a little bit about, but we'll talk about more now, is what do I do with the money? Where do I invest it? And so we're looking at what to do with the money at this point. And most people, if you've got your financial planning and affairs in good shape, are wondering, what should I be investing in, or do what I have invested in, is it work and is it a good investment at that point? Obviously, if you own real estate, that's another topic, but there are ways to own it. LLCs are nice, but California doesn't help you in an LLC if it's a single owner. They'll just laugh you out of court. So there's all that stuff to learn about, but you can listen to YouTube and learn about it. You don't want to combine properties in an LLC because it could all catch a cold and they're all going to be used. And there's other things that you can get into the advanced training. If you're big into real estate, like I said, the private retirement plan that I have is a non-qualified, non-deductible program that isn't, it owns my LLC, and the LLC owns several properties. And because I have a trust administrator and people that do the numbers every year, I'm able to call that my retirement plan, as well as my other qualified retirement plans out there, 401k and all that kind of stuff. But if somebody were to come to sue me, my properties are protected because that's part of the retirement plan.
How come you decided to go the LLC route and not like an S corp or something like that?
To make it very, very simple, and I'm a single owner, and so what happens is the LLC takes in the money, pays the expenses, and then sends it to the private retirement trust, but for simplicity.
Okay, gotcha.
I may be converting my practice to a C Corp that claims S Corp for the tax benefits and that in the future when my son comes into the percentage ownership. And those are getting into the weeds where I know as much as I've watched on YouTube or listened to attorneys. But it can guide you in the right way. So if you get into advanced planning, start watching some videos from various very advanced attorneys, CPAs, and then that'll bring you down to, okay, I'm going to go see somebody. I happen to see a guy in Auburn, but there's other good ones all over the place. And they're not cheap. But it could be worth it once you get there. So when you get into the investments, owning a business, real estate aside, a lot of us are having old 401ks that we roll over to an IRA if you're on your own. Or if you run your own business, you can do your own 401k. Or if you don't have employees, you can do a solo 401k, like a single person type thing. Regardless of what it is, they all go by the term of qualified. And a qualified retirement plan pretty much says this is qualified in that you get a tax deduction going in. It's deductible. So qualified 401k, I get a tax deduction putting money in, but it comes out taxable someday. A qualified IRA, tax deductible, taxable coming out. Qualified tax sheltered annuity, thrift savings plan, whatever the retirement plan is called, if you get to deduct money going in, it's a qualified plan, right? A non-qualified plan would be a Roth IRA. It doesn't qualify for a deduction, but it grows tax-free. And we could sit here all day and talk about the proposed taxes or non-taxes and all that. We have to pretty much take what we have today. So if you're in a fairly high tax bracket and you have the ability to do a tax-deductible retirement plan, a qualified plan, whether you do it on your own as a solo 401k, meaning a miniature 401k that you just have for yourself, or if you have a 401k for employees, or you just do an IRA on the side, whatever it is, you get a tax deduction. And that obviously helps reduce your taxable income now and get you in, has you pay lower taxes and gives you time to plan, one, for the asset to grow, but someday, if taxes aren't lower, you have time to plan out your options. Worst case scenario, you've got a fortune, a lot of money that you've got to start pulling money out soon. What am I going to do? Well, you can move to Nevada and eliminate state tax or some other state. Or what I'm going to do is hire another employee, and that'll eliminate my required minimum distribution. I'll just have expand the people working for me if I need to do that. at that point. So you get, that's a deduction, but that's pretty aggressive. Or you could put solar on the house, get a solar car, but you'll have years to plan out, what am I going to do when that day comes? And it's obvious that taxes will probably be higher at some point, but there's no guarantee. We don't know. Who would have thought we would be where we are on certain issues right now? Wouldn't have dreamed it. Whether you are happy or you're not happy, it's pretty wild of where we are. So it all gets down to a qualified retirement plan if it's for retirement, or a non-qualified account if it's not. So let's say you have two brokerage accounts, one at Fidelity, one at Charles Schwab. Charles Schwab could be your qualified retirement plan. You used to have a 401k, you left your employer, so you rolled it over to Charles Schwab's rollover IRA. Don't combine it with a little IRA on the side, keep it by itself. Then over here at Fidelity, you just decide, I'm going to set up a brokerage account and own individual stocks and bonds, or I'm going to own mutual funds, or I'm going to own exchange-traded mutual funds. And there's a million other things out there I would not recommend doing unless you are your own expert, right? So if you have a brokerage account, in the past you could go directly to Vanguard and buy their mutual funds, and you can still do that, but they're really trying to say, put it in our brokerage account. Makes it easier for their accounting and their administrative work. So Vanguard has a brokerage account you could set up, and you could buy and sell Vanguard funds and everybody else's funds. Not a problem. But other people on the outside may or may not let Vanguard buy you their funds because they don't want the competition or whatnot. There's all kinds of little things to know about brokerage accounts. It's not a huge, big deal, but it's nice to know how Uncle Schwab makes his money. He doesn't make it on the trades. They don't charge it anymore for most things, but he makes it on the cash that's held there. He marks that up like a bank. That's fair. He lends people money to buy and sell on margin, and he makes spreads on things, just like in real estate, right? So if you say, I want to buy this stock or mutual fund, he'll go out and find it at a slightly lower price and sell it to you at the market price, and he makes that spread. And it's not illegal, but it's not something that everybody thinks about. So you're going to usually have your investments, old investments, directly with the mutual fund companies, but now we're starting to consolidate them into a brokerage account. And in here we have an IRA, rollover 401k, whatever, and then over here just a regular brokerage account. Well, the retirement account is going to grow tax deferred. It's not free, but you're not going to pay taxes. So then it allows it to grow over time and not be put on a tax diet. So it's allowed to grow and get bigger without being hit with taxes all the time. But the catch is, sometime when you pull that out, it's going to be taxable, right? And if you pull it out, if you die and leave it to your beneficiaries, they've got to pull it out over 10 years unless they're a legal spouse, right? So beneficiary IRA, they changed that in the last few years, and all of a sudden, you've got to pull the money out in 10 years if your parent left you a big IRA, and that could be very costly. The only thing we can do is maybe buy a business, real estate, or solar to offset it, because if your parent left you a $500,000 IRA, you've got until, or a little bit each year, 10 years to get that money out of there and declare it as taxable. Have we heard about that?
Yeah.
In the old days, you would inherit the IRA and just sign up income over your lifetime. But now it's, nope, you got to pull it out within 10 years. Most people take it over the 10 years, but you could wait until the last year if you had some way of reducing the taxes. So beneficiaries have 10 years. Spouses have the rest of their life. Some beneficiaries, I think I recall if they were disabled or some other exceptions, but most people have the 10 years. And then, as we know, the side thing on real estate, the prop was at 19. It's what it said is you could sell your house and transfer your property tax anywhere in the state as long as it's the same value or less, right? The other thing is if you died, you could leave your house to your kids tax-free. They get something called step-up in basis, right? But they need to move into the house or the property taxes are going to go up, right? And the first million, it won't go up, and then beyond that, it might, from what I recall on my YouTube video I watched. So now I'm an expert. That's the coolest thing in the world, is that, and the expert on any particular topic is the last person that studied it. And then when I get to hear this attorney and that attorney and this CPA, I get the brightest minds in the world. So you can consolidate all that and really get on top of it. But the investing part and the financial planning part, if you hire a financial planner or investor is only that you're hiring somebody to do the work for you. It's not that you can't do it. You're just saying, I don't want to bother with all this, I'm going to hire somebody. I bought a car this year in January, and I'm all stressed out at the end of 2 or 3 months to get a new car. It's just like, oh man, I don't want to do this. Well, if I had to find the perfect property, do I want to do that? And then find out I'm ready, and then I find out something's wrong, I don't know. So sometimes you just say, look, I'm going to hire somebody to do it, and they're going to be doing all these steps for me. It's not that you can't do this on your own, but you're going to have somebody else do the steps. So we have all the diagnostics that we have in the book, the first third of the planning, and then when you get to the last one, look at the investments. We learned what a qualified retirement plan is. That's the old retirement plans, or one you're contributing to now, and then a non-qualified one is a brokerage account over here. So, yeah.
If you're not working, you can contribute to a qualified pension.
No, you have to be earning some money.
But you can earn some money maybe from a property, from rental income.
If you're a manager of an LLC, possibly, Nash, this is...
Yeah, so it has to be categorized as earned income, which is usually, that's what a job ends up being qualified for. But things like a passive real estate investment, that'll be considered investment income or passive income, and that doesn't have the same qualifications. So if it's something you're doing as an active, like, this is my job, I'm the property manager of my real estate holdings, that might be a little bit different, but it has to qualify as earned income.
In my taxes, I qualify because I have some properties in Ireland, and I qualify as I am managing those. So I get kind of a business, whatever deduction.
Right, so
based on that,
if you're running it like it's a business and you're able to deduct business expenses and stuff.
you have to be working 120 hours a year and something like that. So
yeah, something like
that
that.
qualify.
Yeah, that should qualify for earning income. I would
Yeah.
definitely like ask.
Does your accountant take the qualified business deduction?
I do it myself.
Oh, you do it, okay. But check with an accountant because I'm the manager of my LLC. And for some reason, I have other 401ks in my other business, so my accountant said, no, you can't do it. But if you have an LLC and you're the official manager of all these properties and you pay yourself a salary, then you can use part of that to put in a qualified plan. But see the accountant, make sure. They make it very strict. An LLC, limited liability corporation, if you're a single owner though, there's not a lot of protection from lawsuits and things.
In California.
In California, okay. And normally you would want each property to be its own LLC so it protects itself from everybody else. But in the book, you'll find something there about a private retirement trust. And those people that own a lot of real estate, that is one way to protect it from lawsuits and things. And so I hired an attorney, they draw up the documents, and then I hire an administrator to manage the real estate as though it's part of my retirement plan. So if you do want to pay yourself from your properties and deem yourself as a manager, I would see an accountant to make sure that's good. And then whatever you pay yourself, you could do almost 100% of that in a solo 401k, is that right? So let's say whatever you pay yourself as a manager, if the accountant says you can deduct almost all of that, put it into a solo 401k and set up an account at a Schwab or a Fidelity, and then each month or each year you can put money in to get a tax deduction. That'd be nice.
But it has to be an income.
It has to be an income, yeah. But you're going to use, now the income from your properties, you're already going to offset that with the depreciation. But check with the accountant. That's one time I would see an accountant.
Okay.
The financial planners, we kind of come up with the ideas and then send you to the specialist at that point. Be careful though, see the accountant, see if you can do it. But if you can pay yourself a salary, it's a solo 401k or solo something else. They have a funny short name for it. Solo K. I think that Solo K, and they leave out the one in there. So that would be good. So back to these brokerage accounts. You might have several stocks and bonds in a brokerage account, or you might have several mutual funds or exchange traded funds. So you have to decide what you want to invest in. Nash, what's your opinion? Should they do individual stocks and bonds, or should they do mutual funds or exchange traded mutual funds?
Well, the thing with individual stocks and bonds is if you're looking to get the diversification that we recommend, you're going to be buying a lot of stocks and bonds. You're going to have probably thousands of holdings in your portfolio. And if you want to manage all of those individually, great. If you're the best fundamental analyst in the room, go for it. But that's not the type of work that I want to do when I'm managing a portfolio. So usually, if I'm in a qualified account, I can use a combination of ETFs and mutual funds because there's no worry about any kind of tax distributions. But in something like an individual brokerage account, the only reason that I would be a little concerned with a mutual fund is if they're the type of fund that does a lot of turnover, they buy and sell within, because those tax liabilities get passed on to you. It's kind of like when you own a business and those profits and losses get kicked back out to you and you get to either enjoy the income or write off the loss on your tax return. It's the same concept with a mutual fund. They pass those losses and profits on to you as well. So usually they'll retain the losses so you don't actually get the benefits so that they can put it against their own capital gains. But if they have a position that grows a lot and they sell it, those capital gains get pushed out to you as the investor. So that would be a reason to want to use mutual funds that do a lot of turnover in qualified accounts that don't have immediate tax liability, versus with ETFs. We used to say that they don't distribute capital gains. It's possible, but I have never seen it happen one time. So they do a lot of managing, and they do some fun stuff with other like market makers and stuff where they're able to exchange products and not trigger capital gains, some non-taxable exchanges. So a mix of ETFs and mutual funds usually will do the trade, but just check on it for tax liability.
The reason that you would use a brokerage account or buy a mutual fund or anything is liquidity, right? You can put in $100, you can put in $100,000 if you want your money back. You can sell some shares, you can do it all. You can't do that with businesses and real estate. So they balance each other fairly well. So they're liquid. Without looking at all the technical stuff, this is a mutual fund, Vanguard Balanced Index Mutual Fund. I happen to know that I think it's 60% of the assets in the portfolio are stocks and 40% represent bonds. And I think the stocks, I won't bore you with the details, but there's like 4,000 stocks and 12,000 bonds or something in it. So if you never bought anything but one fund, something like this is a nice balance, 60-40. The next step might be a target fund or something like that. But this is just a mutual fund. If you're looking at mutual funds, then we utilize Morningstar's rating service that will tell us more about the fund. We don't want,
sorry?
What's that?
If we want to know about the fund, what did you say that we have to look for?
You could go to the fund company and look up their name online. You'll see a lot of information. But we use Morningstar, this particular company, which will bring together thousands and thousands of funds and give you the analytical information you need. But if you just want to look up a fund, just Google it, you'll get more information than
Yeah, Google actually has a finance website. So does Yahoo Finance, and Google Finance, both. They'll give you enough information to see a little bit about the fund. It won't go in depth on performance analytics and stuff like that, but it will give you sort of an idea of what's going on.
Yeah.
If anything, the problem that we have as investors is that there is too much information.
Too much.
Too much,
Yeah.
far too much.
For sure.
Yeah.
So
that's
how
why-
do you solve that?
Yeah, at that point,
advisor.
it's kind of, you just kind of have to be able to educate yourself on what's important, because, I mean, obviously, we're looking at this report, and there's just a ton of stuff up there, just lots of numbers. And to be honest with you, 80% of that, if I'm building a portfolio, I don't even look at it. Like, as a professional, I don't look at most of that. Like, I'll use some key things, but most of what I'm looking for is what purpose is it serving, what is the fund doing, and is that what I want? So there's a lot of relative measures, there's a lot of volatility measures that, sure, while they can clue you in on some ideas, there's usually only some key things that we look at.
Yeah, and the reason we're looking at this today is just to show you what a mutual fund holds. So here's the holdings. And so a mutual fund is just a file full of stocks, bonds, and or cash, right? The exchange traded mutual fund is the one where, instead of the old mutual fund that you have to buy and sell it at the end of the day, the exchange traded fund takes this basket out to the marketplace and you can buy and sell it quickly. So this particular one, the top holdings, and there are 3,458 stocks and 10,000 bonds. The top stocks are listed here. So you have Apple, Microsoft, Amazon. NVIDIA. So if you see that if you want to buy a fund that has a variety of stocks and bonds in it, this is just a place that they throw them all in a file together for you, and they have certain rules and things that they follow. The other thing that we liked about a fund like this is the expense ratio is 0.07. Most mutual funds have an expense ratio of 0.75. This is a tenth of what most mutual funds charge. So this is not the fund to run out and just buy. It's just, we wanted to show you a list of all the stocks and things that are held in it. That's what a mutual fund will do.
So the management fees for an ETF and mutual funds, they vary very much?
Historically, the exchange-traded mutual funds came out about 30 years, and their big claim to fame was they matched an index like the S&P 500,
Right.
and their expense ratio was really, really low. Back then it was like 0.25, but now they're like 0.05, or Nash, you've got 1.015?
Yeah, that's one of the main funds that I use is, it's literally 0.015.
Yeah, but that's generically because they try to get their costs down because things can be bought and sold, there's less administration, and they're very popular now.
Right.
And so I could say that ETFs statistically are a lot cheaper, but that's like saying it's safe to walk downtown New York. And some people it is, some it isn't, right? There's some ETFs out there that trick you into thinking I'm going to go buy it, and you find out the management fee's really high. You could go to Vanguard, and they're all going to be as low as possible.
Yeah.
There is somewhere where you can find an equivalent to a fund as an ETS.
Yes. Yeah.
So if I would like that, for instance, but
That particular
an
fund?
ETF,
Vanguard doesn't have this in an ETF form yet. They might in the future, but yeah.
But there are a lot of similar things. So
Yeah.
almost most products that can be offered as a mutual fund can be offered as an ETF, but also like a lot of companies will be doing this similar thing. So there's iShares actually does very similar to this. AOM, AOK, and I forget what the aggressive one is. Is it AOG? I don't remember what the
Something like that.
But they also have funds that are like this, that kind of do the allocations for you. But one thing I also wanted to mention on the terms of fees is something that I actually just learned yesterday. So there is a very popular ETF from Invesco, QQQ. I'm sure you've seen advertisements for it on TV. Follows the NASDAQ index, and it actually has higher than some of the index, higher expense ratio than a lot of index funds that we look at. It charges 20 basis points.
Right.
They actually have another one
That
that
was-
is 15, and it's QQQM. And the reason for this is because when you have these really, really high, like they have a lot of assets in the ETF, and it's a little bit more expensive, what that higher expense ratio lets them do, and by keeping that and not starting over with a new fund, is the spreads are actually lower on QQQ versus QQQM. So if you were somebody who traded actively, the original fund would actually be better for you because you're losing less to spreads versus with QQQM. If you're a long-time investor like us, you're not really caring too much about the day-to-day difference between what somebody's buying and selling for, but you care about that long-term management expense.
Yeah, and
Payoff.
the spreads. If you buy an exchange-traded fund, it trades like a stock. So when you buy it, and you buy it at $10 a share, and Uncle Schwab finds it at $9.99 or $9 something, they keep the difference, right? But if you buy a mutual fund, not during the day, from Vanguard, that spread tightens to where you're not giving up part of the principal to somebody. So it's kind of like if you sold a house to a family member without commissions and things, it's a little cheaper than if you go out on the market. So an ETF gives you the flexibility and the quickness to buy and sell, generally lower expenses, but this fund's 0.07. That's a mutual fund, not an ETF. So you can find them, but as Nash was saying, the bigger fund that had a little higher expense ratio had narrower spreads, so you didn't lose on the efficiency. There wasn't friction there. So that there's always things going on. But why would you use these? Because they're different and they're liquid.
So does this tell you what the spread is?
No.
No?
No, because the spread will change literally minute by minute. So
Okay.
it's basically, what it really is it's the difference between two prices. The
Right.
bid price and the half price. Which
Yeah.
would be what's being offered to be bought at, what's offered to be sold at. Because Morningstar is more of a broad-based analytical thing, they don't give price data immediately. In fact, I don't even think you see a share price on these reports. So if you wanted to see what the spread is, the best way to look at, like through your broker or look at a live stock.
And just look at the bid and the ask
Yeah,
price.
so you'll
ask price,
see.
what the difference is
yeah,
the spread.
Yeah, exactly.
Does a mutual fund, though, at the end of the day, narrow the spread?
So spread doesn't apply to a mutual fund.
Okay, good.
Because of the way that it's purchased.
Yeah.
Because an ETF trades like a stock and has bid and ask spread like we know. A mutual fund, it's more, it really is more like being in a private company versus like
Right, because
a
you're buying
public
the shares
trade.
from Vanguard.
Right, so when you purchase a mutual fund or some shares, you say, I want this many dollars of this, and you give them that, and then they give that equivalent to you at whatever the net asset value was calculated at the end of the day.
End of the day.
Whatever happened throughout the day, doesn't matter. At the end of the day, when their calculations run, they go, okay, how much can your 10,000 buy of our mutual fund? And they give that to you. And then when you go back, you're redeeming it for whatever the net asset value
At the
is
end of
at
the
that
day.
day. So instead of there being, say, John versus Joe, like we'll buy from you for different prices, you're just going to Vanguard and they're giving your money back.
And if you have a very stressful, volatile day, the spreads can increase, right? They can
Yeah,
get
so on
wide.
ETFs and stocks, not necessarily if it's a volatile day, but if volume is lower or yes, if it is volatile, spreads can increase, but for slightly different reasons. But the main thing to look out for with spread is just if something is very thinly traded. So if something doesn't have a lot of volume, if there's not a lot of people trading it, because of that, there won't be a very large population of orders sitting out in the market. You want there to be a lot of people trading it day by day at the current price so that you're not, you don't put in a sell order and it happens that the next one that triggers is like 0.5% out this way.
Yeah.
So that spread applies when you're buying and selling?
Yes, buying and selling, because
Well, then it's
because
fine.
a bid and an ask will match your
Right.
buy or sell order. Like
Right.
if you're looking for bid, that matches your sell, so you sell to the bid, and if there's ask, you're buying the ask, if you're using a market order, which is usually what we're doing.
Yeah, if it's something that's heavily traded, then that's going to be very narrow and very low cost, right? S&P 500, total market or something. But if it's an unusual fund, exchange traded mutual fund, and not many people are buying and selling, that's when Nash won't let me buy what I want to buy. Nope, sorry, there's not enough volume and we don't want the client to get hurt. But it's a new self-driving car fund. So now we wanted to get maybe up to 100 million or more volume so it doesn't get very dangerous for you to have the cost. This is a mutual fund. These are the stocks that are in it. This mutual fund is when you buy at the end of the day. But on a portfolio itself, though, you might have a variety of other things held inside of it. And most of what we use is exchange-traded funds to bring the cost down generically, but you have to check each one out because we've seen some that were ridiculously high and unfair, and now everybody wants to be in the game. It used to be just a few providers had these index funds that were super, super cheap. So you can actually get a free fund that has no expense at Fidelity, but that's like a toaster. They want you to buy the other stuff that have higher fees, right? So if you go to Vanguard, you can probably go in with a blindfold on, and every fund you get is most likely going to be the lowest cost in the industry. And they do a pretty good job, but they don't innovate very much. They wait until something's, the industry's done. And they do it in volume and bring the cost down. If you go to Fidelity, you can find some of the cheapest funds in the industry, but you're also going to bump into some higher cost funds. Same with Schwab, watch out for that. And then iShares is kind of in the middle. They have some that are a little higher, but they don't seem abusively high, do they?
No, not really. And again, it kind of really depends. Because, for example, with Fidelity, you can go all the way from a free fund, which, by the way, if you're at Fidelity Zero, that's their category, that's free funds. They have a few. It's not a huge selection, but there's a few there. But if you're at Fidelity Zero will charge you nothing on the expense ratio. But they have all the way up to like 1% or 1.5% because they have really, really specific managed funds that do more for growth stocks and stuff like that. So it really just kind of depends. Some of these companies will range from free to the most expensive. Some of them will be kind of in the middle. But yeah, like you said, Vanguard's going to be your option where you can literally go in, you can just kind of blindly buy 7 different funds and you should be fine expense-wise. Your allocations might not be great, but you shouldn't be paying out the wazoo.
That other fund, that was a mutual fund with Vanguard, and we didn't have the ETF up because I didn't have it on the screen, but this is a portfolio of several funds. We use the word fund. If it's a mutual fund that trades at the end of the day, that's a mutual fund, but an exchange-traded mutual fund you can buy and sell throughout the day. We learned that they could be a bigger spread, or hopefully their expenses are lower. The companies are coming out with more exchange-traded funds, or they're converting to exchange-traded funds. Is it because they're so nice? Probably not, right? They're losing business in the old mutual funds that have high expenses, or other reasons that the investors like you or the advisors like us, we want the accessibility of an exchange-traded fund and the transparency, because we can learn what's in the portfolio, what they're doing instantly, where a mutual fund only has to tell you every 3 months in a quarterly report. And then, even then, they have an extra month if they're late. So you don't always know what's going on. There's nothing wrong with mutual funds. There are managed and non-managed mutual funds, right? What's the difference?
Well, the difference will mostly be, something that's non-managed usually is following what somebody else is doing. So for an example, S&P 500 fund is going to be a non-managed fund, assuming that they don't do anything extra. A total market fund is probably going to be a non-managed fund, but a managed fund might be something like, one of my favorites, Franklin Dynatech, is a tech fund that invests for opportunities within the tech sector, but they're actively going and they're looking for opportunities, they're looking for ways to trade that and be profitable. Granted, in the most overall sense, managers don't outperform their indices. A select few may, but the main difference between the managed and non-managed is managed is way more expensive. But they will do something different. So if you're looking for specific exposure, they can be very helpful. But
Yeah.
non-managed is where we like to put like a bulk of our assets, unless we're talking about bonds, but it's a little bit more of an in-depth conversation. But for the most part, we like those very inexpensive non-managed funds, because if the managers can't beat the market, why don't we just beat the market?
Right.
Yeah.
That's kind of our
So in the
philosophy.
volatile market, would you prefer being in a managed fund or not?
It kind of depends. If it's overall just the market is volatile, period, I would rather just sit it out in my index funds. Like, I would rather just go, hey, the market's down today, cheap shares for me, and I buy some more. That's kind of what our philosophy would be. But it would be a little bit different if we're talking about, say, fixed income and bonds, for example, because there are some bond managers that do pretty well at managing risk, because it's a little bit more, it's not a predictable risk per se, but it's a much easier to manage risk. And it's there are fund managers who have proven themselves much more. So that's one of the areas where we do actually like managed funds, is usually with bonds, just because there are some key performers that we like to side ourselves with. But for the most part, if things are volatile, what ends up happening a lot of times with certain strategic funds, managed funds, is their strategy works kind of only in one direction. So there are some funds that can manage downside risk very well, but those same funds, if you stay there, will miss out on a lot of
Yeah,
upside.
it's risk averse.
Yeah, exactly. Like there's a lot of,
Checking your-
I remember there's these funds that we were looking at a while ago, when it was very popular to be selling call options on the holdings inside to generate income. But the problem with that, though, is when you sell a call option, basically what you're doing is you're saying, okay, well, if price runs up here, I'm willing to sell down here because I'm getting premium and I'm expecting the stock market to stay flat or go down. So in a downward trending market, those are great, but as soon as the assets start to rise, they get called away from you, and now you don't own it anymore, and now it's up 20% and you missed out on all of that.
Yeah.
So it really kind of depends, but in terms of equities, we like to say broad-based, keep it simple, index funds, because at the end of the day, give it 5-10 years, it's going to be back, and it's going to be back strong.
Yeah, just like he said, because if you get scared with the dips, then we start buying other things that promise to take care of you, and they might, but then they don't go anywhere.
Right.
It's kind of like your prized real estate. If you sold options on it because you needed some cash, and all of a sudden real estate took off, you sell it at a low price, you lost the property. But good point, because the last fund that I had, that Vanguard Balanced Fund, right? That was an index fund. An index usually means they're not buying and selling and buying and selling. They'll do slight little readjustments based on company sizes. But that very index fund, prior to the last couple of years, I told people in class, I love this fund, don't buy it. And they go, well, what do you mean? Because It had a fair amount of tech in it, that's fine, but it had bonds that were like 8-year maturities.
Right.
Yeah, and when interest rates go, if you buy a bond at 2%, new ones come out at 3, 4, 5, 6, 7, your resale value crashes. So this fund, I said, stay away from it, or I had a few clients in there just assuming that, you know, it would be okay. This fund dropped 20% 2 years ago. The bonds dropped 20 and the stocks dropped 15, 20, 25. So it didn't help us, but if you took Nash's advice and you just came through that, then the reinvested dividends, they bought more bonds at cheaper prices, some of them matured, and now it's a hero again, and now it looks fabulous. But if you'd, and I was very disappointed in it and kicked myself, but I couldn't get rid of all of them before, when we knew interest rates hit a bottom and they were going to go somewhere. I had clients in this fund, and in the IRAs, we sold it and went to something with shorter term bonds in it. That's fine, but outside of the IRA, the clients had so much gain, I couldn't just sell it and trigger a big capital gains. So that kind of, I kicked myself, but it came through and it worked out. So if you own funds, we always say short-term bonds are a little bit safer. At some point, you might buy intermediate terms. So I bought a little bit recently, and that was wrong. Rates are still the same or maybe still up. So I showed that other layout just to show you this is what it is, a bunch of stocks, right? And thousands in that particular case. Most funds have 50 to 500 in it. This is a picture of a portfolio mixing a bunch of funds in it. I'm not going to go over the details here, but these are the things that we look at with Morningstar. And this will give us the general pie chart you've seen 1,000 times with your stuff. This will tell us whether we have large, medium, small stocks, blue chips versus growth, and this will give you an information on the bonds. And then this part here, you don't want to get tricked with thinking, oh gee, the orange line is this portfolio versus the New York Stock Exchange. It did do much better, but we've got a little bit more technology stocks than the New York Stock Exchange has. We like to compare ourselves to the New York Stock Exchange because it has a broader section of stocks. But if you compare yourself to the S&P 500, it would have blown us away because it was a lot of tech. So it's not an exact comparison. But I'll skip all the details here. This is for a more advanced class. And by the way, we do a more advanced class at Sac State. Did we pitch that already? They don't pay us or anything, but it's nice to have people come. We teach a class for Renaissance at Sac State. CSUS Renaissance, is that what it is?
Something like that, probably just Google it,
Yeah.
yeah.
And how many classes do we have left?
Do we have 3 classes or
3 classes.
4?
Yeah, 3 or 4.
Yeah.
Okay.
Yeah, because we're about to do 9,
Yeah,
right?
yeah, so
Okay.
4 technically, yeah.
Nash is the master instructor for that. I get to sit in the audience. So you could sign up for that either now and do 3 more classes or come back in the fall, right? And we have 12 classes. And we get very much into all the little details, all these other.
We're also uploading those classes online.
Oh, good
so
point.
if it's a little far away for you, or you just want to check it out and see what it's all about, we have
Yeah,
this
yeah.
on our website, so
Yeah.
you can check that out. and-
Yeah, perfect.
and
Go
watch.
online, and we have probably 6 or 7 loaded up there. You could watch them and just get that information. The nice thing is, the classes kind of relate to the book. The book's like 2 years old or so. We'll update it, but it has everything that you need to do. And the whole pitch on the book is, if you want to do your own investing, we're going to teach you how to do it. However, if you have a family member or an advisor doing it, this is what he or she should be doing, step by step. So if you're paying somebody, you know they're doing their job. Because our biggest complaint is, we manage our clients' money. Each portfolio is individualized, but if you go to a Schwab or a Fidelity, they're going to put you in bucket A, bucket B, bucket C. The computer rebalances it and never consults you about your taxes or whether or not that's what you want to do. So for most of our clients, they're customized portfolios.
Can I ask a question? Earlier you mentioned that some mutual funds or some strategies will be looking to harvest both looking to harvest losses at your benefit, and some of them will look to harvest, maybe you're the one that said, look to harvest those losses at their benefit. And
Yes.
you were the one that said, you would offset their benefit. Is there like a one line somewhere in the mutual fund or the ETF that says this is their strategy for how they would deal with harvesting losses? Is there a way to ensure that you get the benefit of
Yeah.
harvesting losses?
Back to the benefit, it will always benefit the fund and/or you, good or bad. So what they do isn't for their own benefit to take a loss. If they take, in the ETF, they can trade stocks back and forth to where you don't end up getting taxed on it most of the time. On a mutual fund, they can sell a stock that's up a lot and they pass that gain on to you. The reason that's good for them is it may make them look good that they got out of it and they can post the gain and you pay the tax. So that may be what you're referring to.
Well, in my case, I know I have some specific funds where the losses are harvested, so I get to offset the capital gains with whatever's been going on. I'm just wondering if there's a way to know that when you're researching a fund or an ETF, and can you always assume that an ETF, I guess you can't always assume anything, but generally speaking, would you assume if you go into an ETF, it's going to be harvesting, it's going to be managed in a way so that the losses are offset by, the gains are offset by losses. They're going to do that automatically.
Yeah, so with an ETF, generally what's happening is they're going to be doing some management techniques to the point where capital gains and losses just don't come to you at all. Like that's not really going to be pushed out to you. The only time, because where you're going to see the capital gains is based on the appreciation between where you bought the share and where you sold the share. Like that's where you're going to pay the taxes.
Yeah.
These distributions with mutual funds, a little bit different because obviously that's internal. So for the most part, I have really yet to see many mutual funds that actually pass their losses out.
Yeah,
So
I haven't seen
generally what they're doing is the way that it's going to benefit you is they're going to retain it. It's like same thing for yourself. If you have like a $9,000 capital loss one year and you can only deduct $3,000 on ordinary income, you carry forward the 6. They do the same sort of thing. So if they don't have gains to offset, they'll hold that. And we can see that in Morningstar a little bit, but they'll retain that for future years so that when they have positions that are at capital gain, they'll net against each other and you won't have any net capital gains distributed out to you. ETFs, for the most part, because of the way that they're able to do business, don't actually kick out any of those capital gains to you for the most part.
Yeah.
And it's complicated stuff that I don't understand.
Yeah, and Vanguard actually has a balanced fund that is tax advantaged to where they will offset gains with losses internally. Now, if you're offsetting losses, you can either do that by selling the ETF if it dropped in value and claim a loss at that point, or if you have somebody managing your portfolio, he or she might sell this that's down and sell something that's up, something that's down and offset it. But be careful though, because if you sell something, it's like depreciating real estate. If you sell something at a loss, sell it at a loss and you buy the exact same thing, not too close, you don't want to get in trouble with the IRS, but let's say you sell the S&P 500 and you buy something very similar but not exactly the same, now you have a lower cost basis. So if that other thing goes back up, now you have capital gains to pay. Now, you could argue that capital gains are cheaper than claiming a loss against $3,000 a year on ordinary income and all that kind of stuff. But in mutual fund, they'll sell and take losses to offset gains when they can, but some of them don't have losses. If they have too much gain, they'll sell it, so they'll go buy something else to make a gain. That's their job, but then you get the tax bill in April, and if you just bought it at an inflated price, they'll sell it and give you back more shares, but now you've got to pay taxes on your own money. And so that gets a little dicey. This is just a portfolio that has several funds in it. There's like 21, normally we only do like 12 or so, but we threw a lot in there. And a lot of these, this was a portfolio from last year. Coincidentally, all these funds have done really good. Vanguard Information Technology, it was down a lot, so we threw it in there. Then that QQQ that we've all heard of it, that was one of the original trusts. That's why you won't see the word ETF, or it's an actual closed-in trust or something like that. You buy a share. But QQQ, and then Fidelity Low Volatility, that may have been kind of flat. And then this is the S&P 500 ETF, and this is with SPDR, Spiders. Have you ever heard of them? You'll start noticing, wait a minute, why did I buy something with Spiders S&P? Why didn't I buy the Fidelity or the Vanguard or somebody else's S&P 500? Our first goal in diversity is have different fund providers instead of just all one company. For reasons I can't think of, like in the space movie. You have to wear this for reasons I can't think of. Something could happen. Vanguard could get hacked. I don't see that somebody steals the shares, but it could take a long time before they could liquidate something because they got to go prove that they own the stock and stuff. So just for reasons we can't think of, we want to be diversified, especially with cyber risk. So you'll see Vanguard, Fidelity, you'll see Schwab, iShares, and Spiders. They're actually they were the first ETF in the industry. And then there's others down the list. Just for fun, this is a diversified portfolio, and the Vanguard Technology, that was a little bit of a buy, and this also Q was technology. But balancing that out with low volatile factor, meaning Fidelity has a stock fund that has stocks of less volatility. It doesn't mean they're going to make them less. It just means they're going to buy Verizon, Procter & Gamble, things that have already peaked maybe, and they have a little less volatility or whatever reason about the balance sheet. You'll see Schwab International Dividend Equity. That's good to have Schwab, and they have a big thousands of positions. iShares you may hear of. Do you hear about that being advertised? That's one of the biggest. I think Vanguard is slightly bigger in the number of exchange-traded funds they offer, but iShares is another name out there. But the S&P's been up a lot. International, I don't know. Minimal volatility, probably a little flat. Fidelity total market, that's been way up. Fidelity aggregated bonds, those should be down 1%. Oops, a little too early to buy those. Vanguard Consumer Discretionary up 25% because it was down 35%. So, and then iShares broad high yield corporate bonds. So we don't guarantee that what you're buying is instantly going to go up. As Nash says, you've got to plan for the long term in the portfolio. But he has a division, part of the money that he does is short-term liquid assets. What do you invest there?
Generally, it could be anything all the way down to money market if you're looking to have a distribution or some kind of expense coming. But then something where you have bonds that mature in less than 3 years, generally.
Yeah.
Closer to 1 year, but super short-term bonds, something like treasuries, or really high-rated corporate bonds, stuff like that.
Yeah, so you could see, and if you go short-term, intermediate, long-term positions in this portfolio, this would be, the bonds in here would be intermediate term, and if there's cash and things. But his short-term positions, he might do money market funds, tax-free or not. He might do CDs or T-bills. T-bills are state tax-free, not federal. Individual T-bills, not a fund. So if you have oodles of cash and you're waiting to buy something for cash, buy T-bills, go to governmentdirect.org, and you can buy T-bills directly, and the interest is not taxable at the state level. And they just print more money if we have another catastrophe.
I mean, it's true what Nash was saying about things, the value, if there is a drop, no?
Yeah.
But it depends as well of the entry price. Right now it's so high,
Yes.
so.
Well, most stocks are high. In
I
the
mean-
in the S&P 500, right, the top 30%, the top 8 stocks or so, are way overpriced. But all the other stocks are flat. So if you do a fund that is the S&P 500 X technology or not those big stocks, then you're not overpaying for some of them. They're not overpriced. But generally, the biggest stocks that control the market are highly priced. I can't say that they are overpriced. What do you think, Matt?
It's hard to say what is overpriced and not overpriced. I don't like to use those words a lot because a lot of the times that's trying to assume that there is a fair value of a particular stock.
Mm-hmm.
And that doesn't necessarily, I don't think, necessarily exist in the marketplace because the marketplace is not driven just by value. The marketplace is driven by value, yes, but it's also driven by sentiment. It's driven by what people think, and it's driven by money flows. It's driven by where portfolio managers put 401ks and where they put pension plans. That drives a lot of volume in the stock market. So it's hard for me, it's difficult for me to say whether things are overpriced or underpriced in a general sense. Like if we're trying to look at fundamentals, maybe I want to be interested in how much free cash flow a company has. But at the same time, inflation could just keep going and things just get more expensive because they get more expensive. And by virtue of that, stocks would become more expensive because a dollar can buy less of a stock, and so now the stock is worth more. So there's a lot of factors that go into play in determining what a value is.
But how much will be the PE that you will consider overvalued?
Just like overall, Again, it's really difficult to say because like tech companies and growth companies will skew that by a lot. Because, I mean, you'll see those at hundreds. And I remember.
But that's expensive.
I remember one day I saw Tesla at 1,000 price to earnings ratio. And I couldn't even believe that.
And
was
look where
real.
is Tesla now, going down like there is no tomorrow.
Yeah, I know, exactly. That's been killing the ARC funds, the ARC technology funds. Those are just falling through the floor right now. But generally in the industry, somewhere like between 10 and 15 and maybe under 10 is kind of considered a like fair evaluation. But again, it's hard to see a lot of those in a lot of companies because you'll see a lot of, even pretty blue chip stocks will be at 20, 30, 40, 50.
Yeah.
So,
The S&P has a history of 17 to 25 price earnings ratio. However, if you have technology, let's say an AI company, maybe there's not a lot of earnings, right?
Mhm.
And that could blow you away someday, but if you valued it based on our earnings, then it didn't have much value at that point.
yeah.
As we get closer to retirement, price earnings ratio is more attractive because it's a little more predictable. The company's creating profits right now. We're buying a milk producing cow versus for meat type thing. So you have to look at it that way. Or a little bit similar to real estate is if I'm thinking down the road long term, a piece of land might be a better buy and a cheaper price, but I have to wait it out and earn nothing for years and years and years. Then all of a sudden they build a Walmart next to it, boom, it's worth a lot. But do I want to wait that long or not get anything for it? Whereas if I buy a rental that's, I pay cash for it, it's got a lot of rent, it's falling in its structure, but it's got cash flow, I get the cash flow now, but its appreciation might not be very great. The land is a big guess, but things like that. So price PE ratio is important, but you will miss the upside on a lot of stocks if we only look at it that way. But we remember back in 2000, .com was brand new, and then you had companies selling for 1,000 times earnings left and right, and a lot of them failed, but not all of them failed. And Microsoft tanked 50%, right? Oh, I should have bought it then. Well, that would have been a gamble. If you have a fund, usually if it's an index fund, you're going to already own these. Now, are they overpriced right now? Maybe. So then what we'll do is if we have a client that comes in, we reallocate or we have cash, nobody knows whether the market's going to keep going up or down. But in the short term, if Nash has short-term, intermediate, long-term horizon funds, money markets, balanced and intermediate-term bonds, growth funds, then if the market tanks and you need money, you go to your reserves over here, right? So that buys you time to get through the bad times. But if you're needing to liquidate the money, we shouldn't be invested at all, right, at that point. So we don't, but overall, you'll look at something like this, and we won't take a lot of time, but somewhere on here, I think it has price earnings ratio on average for these things. And that would give you that information. But anyway, I brought this up to give you an idea that here's a portfolio with several things in it. These little charts, don't want to bore you with the details, but this one's kind of fun. This is like a diving board that gets more springy as you go out here. So this one is a negative volatility, this one is 20% volatile, or S&P 500. What's that mean?
In terms of volatility, we're talking about standard deviation?
Yeah.
Okay, so standard deviation, it's kind of a factor of two different things. First of all, what standard deviation means, just in a broad sense, not even financially, is how far some number is expected to deviate from what is generally considered its average. So if we're looking at something like an S&P fund and we're assuming it returns 10% a year, and we see it has a 20% standard deviation, that means on a very normal basis, about 70% of the time, we're going to see anywhere from that 10% average return all the way up to a 30% positive return, all the way down to a negative 10% return. But standard deviation really, it kind of gives you an absolute measure of how much you should be expecting it to fly back and forth in either direction. Even if it's trending upwards, you'll see a lot of times where we'll move up and we'll move down very strongly, and those numbers kind of get averaged into what is considered the ballpark of where we expect it to move back and forth between.
Yeah, you or whoever manages your money should be acutely aware of all these little details we'll talk about in the next couple of classes. because we want to know what the history is, right? If I'm going to buy real estate, I'm going to go to the fire department, I'm going to go to the police department, I'm going to go to zoning, I'm going to find out what's happened before, where is this going, and have some idea of what you're getting. It doesn't guarantee that we can predict anything, but we want to know what the history of these funds are. And a fund that's been down a lot, if it's a legitimate fund, if you, let's say Vanguard Energy Fund in 2020 dropped 50% or so, right? Well, I had clients that I bought into that, and there's another one. But we were looking down a dark hole. Am I throwing money away or not? Do you want to go for it? It's on sale. They have tankers out there. They can't give oil away. Do you want to do it? Yes, let's do it. When we bought it, it was a sick feeling in my stomach. But then since then, it's gone up like 3-4 times. But it wasn't that I knew that. You just had to take a contrary position if you wanted to take the risk. If you didn't want the risk, then we bought high dividend stocks that were more stable. But in 2020, they dropped more than technology stocks. What? How could this be? The market just crashed. Tech stocks should drop more because they had no earnings. And these big fat dividend stock funds dropped more than the technology stocks. And the reason was, if COVID was going to shut everybody down, then what good is a high dividend, boring, old, over-the-hill stock that has high dividends if they can't run their business? You're not going to get that 6% dividend. So if I'm not going to get 6% dividend, I'm going to wait for Amazon to come back. What's the point? So they didn't stop doing business, and we did buy them at a discount, the high dividend blue chip stock funds, and they came back to their normal position. But you can't guarantee anything. You have to do what's right for you. To answer your one question, the price earnings ratio average for the portfolio is 17.5 here. So that was kind of similar to that other one. And a lot of these funds are a little bit more conservative than that. Any questions so far?
What you said, 60-40 is kind of conservative.
Do you think it's conservative?
I wouldn't say it's necessarily conservative, that's kind of mid-range. Anywhere from 50-50 to 60-40 is considered moderate. If you want to go conservative, again, it's kind of just using an equity bond split is kind of missing the point a lot of the times, because a lot of these companies will use long-term bonds, and then your risk doesn't really go down. It ends up being really bad if interest rates go up, and you could lose more than somebody else. But in terms of, if we're looking conservative, I would be looking at numbers like beta and standard deviation, because those are relative measures.
Standard deviation and?
Yeah, and beta.
Beta.
So those two things, standard deviation being kind of a raw measure of how much it moves up or down, and beta will be kind of a relative measure of how much risk you take compared to the market. And I think those are much better indications of what you'll see versus just a straight up equity bond split. But if you want to start going conservative, having 40% or less in stocks, and then having most of it in shorter term bonds, a little bit of intermediate terms, high yield, that would be closer to conservative.
It all depends on what the portfolio is designed for.
Yeah.
It's like putting different tires on your cars. Different ones on sand, different ones on ice, and not all that. If you have an IRA that's built up pretty big that you're contributing to, number one, if you're contributing, then the volatility can be greater because you can buy it on the way down, right? And if it's an IRA that you're never going to touch for decades, then 60-40 is too conservative. That should be 80% stocks, because the 20%'s there when the market crashes, you can move it back in, and you're buying into the IRA once a year or a few times a year, that's fine. But if I'm retired and I move this massive 401k into my qualified account, my rollover IRA at Schwab or Fidelity, and now I'm saying this is my last chance, I'm not risking it. Now a 60-40 portfolio, 60% stocks or 60% bonds, you dilute it to the point where it works for you. If you're out at a party and somebody says, have a drink, well, I'll put 90% water and a little bit of alcohol in there because I'm going to drive or something. So you dilute the portfolio with cash and bonds to stabilize the volatility. But if you're not going to touch this money for years and years, or it's for the kids or the grandkids, then obviously you always make more money long-term in stocks. Now, why can I say that the stock market's almost guaranteed to recover and keep going up?
Historically, that's been the case.
Historically, yeah, but that would be recency bias, so we don't know. The real question, in my opinion, is our population on the planet's not going down. Now, we all wish that we didn't have so many people being born, but there are. And they're demanding goods and services. And more lower income countries who have a right to upgrade their standard of living are doing so with the help of different countries, but they're starting to buy bigger products. That's why China will go all over the globe and try to get involved to get people to buy their cheaper products and other nefarious reasons. So keep that in mind, that in the long term, but what is long term? I have no idea. Statistically, Nash might tell you, well, there's a bear market every couple of years, and it takes, how long on average to recover?
Some could be a few years, some could be almost a decade.
Yeah, we've seen 2008, as you did, the S&P 500 took 10 years. But if you were buying into the S&P, now you're really happy. But if you bought the S&P all at once and it dropped 50%, you're pretty upset. So it's not, providing that the investments are legitimate, Vanguard, Fidelity, Schwab, so on, they're fair, and you can look up their expense ratio, provided they're there to earn the fee to manage it, they want to do the right thing, then now you've got to allocate things based on your needs, not somebody else's. I have one pension part of my plan is like, ooh, that's pretty conservative, and then the other one is total market right into the stocks and it's up and down. But the other one I add to every year, so, and I'm doing now monthly, so I can buy whatever's down and average it out. But if you're not going to be buying into this investment, you need either a lot of dividends to sand down the edges, or you need to wait a long time for things to recover. It's kind of like a bond. If I bought that 30-year bond at 2%, now the resale value is 60%. I blew it, but if I buy more of the 30-year bonds with the dividends, I kind of make it back, and someday the extra money bought at a cheap price, but the old money bought at too high of a price. So it's not what you do, it's how you do it, provided everything's legitimate. We don't recommend individual stocks and bonds for liquidity problems. Bonds during COVID, there were bonds you couldn't sell to anybody. No one would buy it. But the same bond in an exchange-traded mutual fund sold, because the people knew there was a basket of bonds they could get in and out. They knew there was a market out there. Spreads may have increased on anything that there's not a lot of trading activities, because there's market makers and authorized participants that have to buy these shares if you want to sell them, but they don't have to pay a high price. They can give you whatever you want. So beyond owning a business or real estate, which have their really good years in and of themselves, and there's reasons to do those, the liquidity part of your investing is also very, very wise. Because if you talk to Warren Buffett, he's not into real estate at all. He's made a huge amount of money, but he's also had a lot of time. He's made some real goofy mistakes, and he's come out of it. Real estate, on the other hand, allows you to leverage it with a loan, put tenants in there, they pay for it. There's a lot of great things about it. But you could get stuck. My building's on Main Street. I couldn't give them away for a while. Nobody wanted to buy them. Nobody wanted to rent them, and I sat there empty for 2 years. But I had a business I'm running, and we could do renovations. But young people shouldn't go out and just buy a rental at whatever rates that are. Interest rates now seem high. Nash, they seem high to you?
They seem high in my perspective because of how long I've been on this earth, but yeah.
But when I bought my first house,
18%.
yeah, 18%.
But the numbers were so much smaller.
Yeah.
Yeah, it was fair, because if the interest rates went up, the price went down. So the best thing to do, if you have to get a loan, is buy a house when interest rates are at 18%. The best thing, because you get a price way down here, and what do you do when rates fall?
Refinance.
You refinance, so now you've got a low purchase price and a low interest rate, if they fall at that point. 7%, we used to laugh when I first mortgage, and then you could assume the mortgages, right? Now you can assume FHA and VA, right?
But now the prices of the houses are very high.
Very high.
Never, and the interest rate.
Interest
So-
rate's not attractive,
No.
but that's the thing that's killing us, because if we can't encourage people to sell your house for somebody else to buy it, pay a new property tax, and pay a little bit of capital gains when you sell it, then all of a sudden the state's not bringing in the money it did.
It's so true, yeah.
And-
We have such a log jam now for that very reason.
Yeah. I'm not going to refinance. I've got a small mortgage at 3.5%.
Yeah.
Why would I do that?
Yep.
And why would I sell if I've got to lose 100 grand just to buy the same house somewhere where there's no dogs barking?
And you'll be paying higher interest rates than you have now.
Yeah, and that's going to kill us. We need to give people the incentive to buy and sell, and that way the state and the federal government can get its tax money on a fair basis.
They can reduce the interest rates and stop wasting money, you know?
Yep.
The government.
Yeah, their debt, we're not going to be able to pay the debt with these high interest rates and things like that. So those are a lot of things that when you're doing your investing, I would stay with the exchange-traded mutual funds. If you can't find an exchange-traded mutual fund that meets your needs, a regular mutual fund's fine. That one Franklin Dynatech fund that Nash likes, the managers happen to do an extremely good job, but it's with Franklin funds, which historically was a commission-based company. And they did have advisor shares, but generally speaking, their management fees and everything, we didn't like it. But this one fund meets a niche. What's the management fee?
I believe it's somewhere between 70 and 80 basis points, something
Okay,
like
so
that.
0.75, 3/4%,
Probably.
which normally we would screen it out, not even look at it. But at T. Rowe Price Capital Appreciation or Franklin Dynatech or something that they're doing such a good job, then the expense ratio doesn't matter because you'll see the mountain chart of your fund do this, the good one, and the other ones are here, so what does it matter? And they're so good they can charge more. But there's not a lot that anybody can, I'm so good. It's just that their factor-based investing or their philosophy works. They stay with it, whatever Dynatech does. Technology, or let's say you're going to do Bitcoin or a digital currency fund. I'd rather pay somebody a higher fee that knows what they're doing, right? But if they're going to do an index of one of everything, then Vanguard will come out with a digital currency index someday, and it'll just be one of everything, and it'll be low cost. Vanguard makes it on taking over the market with things like that. So we would say funds, preferably exchange-traded funds if you can, but those can be dangerous during the day, so we don't want you to do day trading. That could hurt you. But mainly because that's the way of the future. All the funds that are coming out now are mostly exchange-traded mutual funds and fewer new mutual funds out there. But stay with the lower cost if you can.
When you say funds, you refer to ETFs as well, no?
Yes,
Okay.
yeah, regular mutual funds that you buy from the company or exchange-traded mutual funds that this company sells in the open market and you can buy it through. I would generally say look at exchange-traded mutual funds. You should find everything you want there. Would that be correct?
For the most part, yeah. Yeah, the only thing that I noticed, there are just a good amount of like index funds that are really, really, really cheap when it comes to mutual funds.
Right.
Like, I mean, that Franklin Total Market is
But
1.5 basis points.
Fidelity total market.
Fidelity, yeah,
Yeah.
sorry.
but it's not tax efficient, or at least it's less tax
Well,
efficient than the.
it depends. For an index fund, it will be. Because with an index fund, for the most part, what's happening is there's not a lot of turnover. That's what triggers capital gains. So if you have a managed fund like Franklin Dynatech or like Capital Appreciation by T. Rowe Price, they're buying and selling in order to create more capital appreciation in the market, and that's what's going to get kicked out to you. But if we're looking at an index fund, while technically there are positions that could be eligible to give you capital gains, for the most part, those positions don't change until they fall out of the index. So if I have Microsoft in this total market index, that's almost never going to leave. So they're never going to have a reason to sell that position because they're just going to maintain it at the same proportion as the stock market is overall, and they're just going to be holding it.
Yeah, but you're absolutely right. In 2008, you were absolutely right. Vanguard S&P 500 fund never buys and sells, but when there's a run on it and people are panicking saying, I need my money, and they don't have enough cash on hand or enough buyers, they had to sell. And that triggered capital gains. But generally speaking, if you have an index fund that is not in the form of an exchange-traded fund, go ahead and buy it because they're going to do everything they can not to trigger the tax. Or the Vanguard Balance Fund, they have the balanced tax-efficient fund, you could do that. But the ETFs would be the best place.
And what will make you decide to go with one or the other? The management of the fund, it has to be something. No?
Yeah, for the
Or what?
most part, what has me decide whether I'm going to use an ETF or a mutual fund, it's mostly fee, like am I paying more of a fee for the same thing? And then what kind of account is it in? Because if we're talking about these capital gains issues, if we're talking about an IRA, to the point, it doesn't matter. Because we're going to pay ordinary income coming out of that anyway, capital gains doesn't matter. But if we're just talking in generalities about a brokerage account, the capital gains, that might be a bit of a conversation if it's a tax concern, but for the most part, it's am I paying the least for what I'm paying? Because there's just no point in paying double fee for the
Yeah.
same thing.
Fidelity's total market index fund that Nash uses is 0.015, but if they had it in an ETF, we'd probably use that, right?
Yeah, probably.
But they, for whatever reason, they don't have it in the form of an ETF.
Fidelity, total what?
Total market
Total market.
index fund. Yeah.
Yeah, I think it was even in our list. maybe.
Yeah, it was. It was one of the holdings. It
Yeah.
was-
So this is just for fun. We'll cover the actual outline we'll do next week and get a little bit more into those. But all this information is in the book if you want to do a deep dive. But if you don't want to do a deep dive, we want you to learn enough to where you know, wait a minute. Because I've had clients come in, even after the class. We always tell people, bring your stuff, you don't have to become our client, we'll look at what you got and point out some things and then you can go fix them if you want. But one guy came in, well, why would I want to pay you a fee? And I said, well, that's fine, you don't hire us because we do the work you could do, but if you don't want to do it, then we get a fee to do it. But then it comes to find out, his mutual funds that he paid 5.75% to get into have a management fee of 1% a year. It's like, oh, that's not so good. So you do it by yourself, or if you have somebody do it, the first common denominator is get the cost of the funds down to what for the portfolio, Nash?
Generally, if I'm looking at cost, if I'm keeping it really simple, it could be between 10 and 20 basis points.
Okay,
like
so-
this one here is 17.
Yeah, 17, 0.17. Whereas if you don't watch out, some of your old American funds, Franklin funds, Templeton, all that stuff, those will be 1% plus. And those companies aren't dropping the fee because they can charge it. People aren't looking at it. It's old money. I'm not going to do anything. But they are starting up new exchange traded funds mirroring the old fund at a low cost. So these companies, it's kind of like if you have tenants, if rents went down, do you want to drop the rent? Well, I did because I was afraid of losing. But generally, if you're getting a good deal, most people don't want to do that. So this expense portfolio, the average is, actually the gross is 0.18 and the net is 0.17. I don't know what that is. Are they selling options on anything?
No, it's not going to be anything like that.
Okay.
It probably has to do with, I don't know, probably, yeah, I'm not sure what would be changing
Yeah.
that number. But usually the difference between the two is like 1 basis
Yeah.
point. I never see it
Yeah.
be anything major.
Some funds can actually lend out your stocks in the fund like Apple and they can make some revenue, but they pay you, the fund, not themselves. So we could have you here for the whole year. A lot of, but the main thing you want to be able to do is know you're not being taken advantage of on anything. Okay, I've got all Vanguard, well, that's a little too much with one company, but okay, they're all legitimate funds. Now the allocation is important. If you have a long time horizon, it's almost all stocks, some bonds just for buying opportunity if you need to cash them in. But if you're getting near to having to live off it, and the most near person is not a retiree, it's a college student, right? Grandparents put aggressive growth, a little less aggressive growth, okay, growth, balance. Now I'm 18 or I'm 23 and I need to liquidate it, all of it. That needs to be toned down into cash, not growth stuff. Even though the college kid's 23, they're going to liquidate and buy tuition. So theirs is a real liquidation. Grandma could be living, toning it down, but she might live a long time, or if she dies, it goes to younger people. The college student, or if you're buying a house, we've got to be careful of that because the market could tank once they need to liquidate. And I have a couple that said, well, we inherited this money, we're going to buy a house. When? Well, I don't know, maybe a year, maybe 3 years. I'm going, come on, give me an idea, because we ended up buying CDs, I think, and cash and money markets. And, you don't want to take the risk. So if you need the money, it's better to complain that you didn't earn as much than if the market tanks on you. And the market tanking is good news. It's not bad if you're reinvesting dividends, and better yet, you're buying. Now today, if we got a new investment of cash, the market may be overpriced, may not. We might divide it up over 3 months, 6 months, and buy in over time. That way, if it crashes, we have bragging rights, and if it goes up, at least some of the money was invested. But it's a fair game, and I say fair, not really, because people cheat, but it's a fair game generally in the market. We don't want to get too far ahead of ourselves. So we're at the end of the class, sorry. Any last questions at all?